There are moments in financial markets when nothing seems to be happening, and those are often the moments that matter most. Not the headlines. Not the hype. Not the sudden spikes that dominate social media. Real power moves quietly. It accumulates patiently. And when it finally reveals itself, it rewrites the rules overnight. What you're about to hear is not a story about speculation or short-term trades. It's a story about control, supply chains, and the invisible forces shaping the next economic era. Right now, silver isn't screaming for attention. It's whispering. And that whisper is telling us everything. There's an old saying inside intelligence circles: the loudest threats are almost never the most dangerous. The real danger comes from what moves quietly, methodically, without drawing attention. Financial markets are no different. We've been trained to hunt for noise: the explosive green candle, the violent red crash, the chaos that signals panic or euphoria. Volatility feels important, so we assume it is important. But look at silver right now, hovering in the low $60 range, and something feels. There's no drama. No fireworks. The price drifts down a few cents, then snaps back. It rises slightly, then stalls. To the average retail trader, this looks like boredom. A failed rally. A market that's lost direction. That surface-level read couldn't be more wrong. Because when you look past price and focus on volume, the picture changes completely. What looks quiet on the chart is, underneath, a battlefield. Over the last several sessions, enormous amounts of paper silver have been dumped into the market. Banks have pressed shorts. Algorithms have unloaded size. And yet, despite all of it, the price refuses to break lower. What? Because someone is standing there. Someone enormous. Someone with deeper pockets than the bullion banks. Someone placing a buy order so large it's absorbing global silver supply without even flinching. This isn't a Reddit-style squeeze. It's not a hedge fund chasing momentum. This is a strategic buyer building a position that fundamentally alters the balance of power. In this 4-part investigation, we're going to track that buyer. We're going to use forensic market data to show that a massive wealth transfer is already underway. We'll connect the dots between the AI energy crisis and the sudden vanishing of physical silver. And we'll explain why a flat price paired with heavy volume is one of the most bullish signals markets can produce. This market isn't dead. It's loading. And the only question is whether you're standing with the whale or in front of it. To understand what's happening around $63, you have to understand how smart money actually buys. If you or I want silver, we click Market Buy. The price ticks up slightly, we get filled, and that's it. But if you need to acquire $650 million worth of silver, roughly 10 million ounces, you can't do that. Hitting Market Buy would instantly send prices vertical. You'd destroy your own entry before the order even finishes. So institutions use something else: iceberg orders. An iceberg order shows a tiny amount on the order book, maybe 5 contracts, but hides tens of thousands more underneath in dark pools. Every time a seller hits those visible contracts, the algorithm instantly reloads them. Sell 5, reload 5. Over and over. The price stays pinned, but volume explodes. Sellers believe demand at that level is endless. Eventually, they run out of ammunition. And when that happens, the wall disappears and price gaps violently higher. That's exactly what we're seeing now. Every attempt to smash silver below $63 hits an invisible concrete floor. It doesn't bounce. It doesn't react. It simply stops. That's the whale feeding. Based on recent volume turnover, we estimate that a single entity has absorbed somewhere between 10 and 15 million ounces in just days, roughly $650 million to $1 billion in capital. Who can do that? Not hedge funds, they avoid commodities. Not retail, retail is exhausted. Not bullion banks, they sell rallies. They don't defend floors. This footprint belongs to a strategic buyer. A corporate entity that doesn't see silver as a trade, but as survival insurance. Someone with a decade-long horizon. We are witnessing the accumulation phase of a generation-defining cycle. And the longer price stays flat, the larger the eventual release. What's happening here is a classic handoff from weak hands to strong hands. Weak hands are speculators who bought at $50 hoping for a quick flip. They're nervous. Every dip scares them. They sell into fear, providing liquidity. Strong hands don't flinch. They have long-time horizons and deep conviction. They buy panic. This process is essential for a true supercycle. It's how markets build foundations. You don't construct skyscrapers on mud, you pour concrete first. The $63 level is becoming that concrete. The fact that silver hasn't crashed after a major run tells us the market's character has changed. In past cycles, vertical rallies collapsed because they were driven by paper hype. When excitement faded, price followed. Today hype is gone but price is holding. That's the signal. Demand is no longer optional. Someone has to buy. To the casual observer, silver looks dead. To professionals, it looks cornered. So what about the obvious objection? Aren't banks just covering shorts? The data says no. First, timing. Bank short covering usually clusters around fixing hours or the close. This buying is constant, Asia, Europe, US pre-market. Relentless. Algorithmic. Second, physical premiums. If this were paper short covering, physical premiums would compress. Instead, they're rising, especially in Shanghai and US wholesale markets. That means metal is being pulled out of the system, not rolled forward on paper. Third, sector behavior. Silver is decoupling from gold and aligning with copper, uranium, and AI-linked assets. That tells us the buyer isn't betting on monetary collapse, they're securing industrial supply. Which leads to the real question: who has tens of billions in cash, massive energy needs, and zero tolerance for supply risk? Big tech. Microsoft, Google, Amazon, Meta. In part 2, we'll connect the dots Wall Street refuses to discuss. The $100 trillion AI revolution doesn't run on code alone, it runs on electricity. And electricity runs on metal. Data centers, power grids, solar farms, all of them depend on silver. AI doesn't live in the cloud. It lives on silicon, powered by electrons flowing through silver. A single AI query consumes 10 to 30 times more energy than a standard search. As models grow smarter, energy demand goes exponential. The grid can't handle it. So tech giants are building their own power infrastructure, and they're discovering the silver market is far too small. In late 2024, BlackRock and Microsoft launched a $30 billion AI infrastructure fund. Read the details: data centers and the energy systems to power them. For perspective, global annual silver mine supply is worth roughly $25 billion. One fund exceeds the entire industry's yearly output. And that's just Microsoft. Add Amazon, Google, and Meta, and you're looking at over $100 billion committed to energy infrastructure, under strict net zero mandates. Fossil fuels are off the table. Nuclear takes a decade. Wind is unreliable. That leaves solar. But high-efficiency solar requires silver. If even $10 billion of Microsoft's spending goes into solar, and silver represents roughly 10% of panel cost, that's $1 billion in direct silver demand, almost exactly what we're seeing absorbed at $63. This isn't speculation. It's procurement. Efficiency improvements won't save the supply. Jevons paradox applies. As solar gets more efficient, we build more of it. AI data centers run 24/7, requiring massive overbuilt solar capacity and storage, 3 to 4 times the panel capacity per gigawatt of compute. The tech giants know the math. Net zero AI with current silver supply doesn't work. So they've made a choice. They're not squeezing price. They don't care if silver hits $100. To them, silver is concrete, just a construction input that must be available. They're putting a floor under the market and draining it slowly. This is a return to an old strategy. In the 1920s, Henry Ford didn't just build cars, he bought iron mines, rubber plantations, coal reserves. He understood that control of the resource meant control of the future. Just-in-time supply chains died in 2020. CEOs learned the hard way: if you don't own it, you can't rely on it. And right now, silver is being claimed quietly, relentlessly by those building the next world. What we're witnessing now is the return of something markets haven't seen in decades: vertical integration on a strategic scale. Tesla is building its own lithium refineries. General Motors is buying direct stakes in mines. And now, the tech giants are doing the same, quietly assembling reserves of critical metals. These companies are no longer just corporations. They are starting to behave like nation-states. Microsoft holds more cash than most countries. Apple has more geopolitical leverage than many governments. So ask yourself this: why would entities like that trust open commodity markets to deliver the single metal their future depends on? They wouldn't. And they don't. Instead, they're building private stockpiles, likely in Nevada, Texas, Ireland, warehouses filling with industrial-grade silver. Not to flip. Not to hedge. To use. Once that silver enters those vaults, it is effectively gone forever. It won't show up on COMEX reports. It won't be leased by banks. It won't re-enter circulation. This is dark inventory. And because it's invisible, the market has no idea how tight supply truly is. We look at public inventories and see 30 million ounces. What we don't see are the tens of millions sitting quietly in private vaults owned by shell entities linked to big tech. The whale defending $63 isn't just buying, it's building a fortress. And once that fortress is complete, price support disappears. By then there will be no metal left for anyone else. So now we have clarity. We know who the buyer is, big tech. We know why they're buying, the AI energy crisis. We know how they're doing it, iceberg orders and off-market storage. The real question now is, what does this mean for you? It means you're swimming in dangerous water, but for the first time ever, the biggest predators are moving with you, not against you. They want prices suppressed while they accumulate. But once they're finished, they want prices to explode to lock competitors out. In part 3 we confront the fallout. What happens to every other industry that depends on silver when big tech consumes the supply? What happens to medicine? To defense? And most importantly, how do you position yourself behind the whale, using its momentum without being destroyed by its turbulence? The buyer is holding the line at $63. That's the signal. The accumulation window is open, but it's closing fast. If you've followed this investigation so far, the picture should now feel deeply unsettling. The buyer at $63 isn't a trader. It's the AI industrial complex, the combined force of big tech and global energy infrastructure, quietly absorbing physical silver to build the electrical backbone of the future. They have over $100 billion in capital. They have net zero mandates. And right now, they are draining the global silver float through silent accumulation. But here's the question no one on Wall Street wants to ask. What happens to everyone else? Silver is a zero-sum market. Roughly 830 million ounces are mined each year. If Microsoft, Amazon, Samsung, and others suddenly require an additional 200 million ounces annually, that supply must be taken from somewhere. From someone. This is called crowding out. When a giant enters the room and consumes all the oxygen, smaller players suffocate. The industries about to feel that pressure aren't speculative, they're critical. Medicine, defense, public safety. Silver isn't just money or solar panels. It's the most antimicrobial element on Earth. It's embedded in burn treatments, catheters, surgical tools. And it's foundational to modern warfare. A single Tomahawk missile contains hundreds of ounces of silver. Fighter jet cockpits use silver-coated glass. Torpedoes rely on silver-zinc batteries. These sectors are price inelastic. Hospitals can't switch materials without killing patients. Militaries can't downgrade components without losing wars. So what happens when big tech drains the supply at $63? Procurement departments wake up too late. Refineries answer the phone and say, sorry, it's already spoken for. That triggers a bidding war, not between traders but between national security and public health. The US military may invoke emergency powers. Big tech has the contracts and the cash. Either way, price is forced higher. This isn't intentional sabotage, but it is unavoidable collateral damage. From an investor's perspective, understand this clearly. You're not betting on hype. You're holding the one asset that Microsoft, Pfizer, and the Pentagon all need. That's not speculation, that's leverage. So who loses? Jewelry, silverware, decorative demand. In places like India, silver is cultural, a store of wealth worn on the body. But when prices climb high enough, culture yields to economics. Jewelry gets sold. Scrap enters the system. This is the market's only pressure valve. The whale is counting on it. But here's the flaw: scrap supply is slow. It takes years to mobilize, refine, and scale. Meanwhile, industrial demand is immediate. That timing mismatch is what causes prices to overshoot violently. Silver is becoming too valuable to wear. Too valuable to eat off of. It's reverting to its original role, strategic infrastructure. Now let's talk about strategy. You're not the whale. You can't move the market. Fighting the whale gets you crushed. Trying to outrun it gets you shaken out. The winning strategy is drafting. In racing, drafting means riding the slipstream of something larger. The resistance is reduced. The speed increases. The iceberg at $63 is your engine. The whale is spending billions to defend that level. Your rules are simple: do not get bored. Boredom is the trap. Flat prices are designed to shake you out. Buy the base. When price tests the lower end of the range, you buy with the whale. Respect the volume. High volume plus flat price equals accumulation. Low volume equals completion. If you hold physical silver, store it like the whale does outside the banking system. Eventually the sellers run out. The iceberg disappears. And when that happens, price doesn't climb, it teleports. This is the vacuum. Above $65, there is no resistance. History shows silver barely spent time in the $70s or $80s. That creates an air pocket. Once entered, small buying pressure causes massive price movement. This is why the markup phase is violent. You'll see $4 days. Then $3 more by lunch. The media will scream bubble, but it's not. It's price discovering where supply might exist. Before that breakout, expect one final shakeout. A sharp dip. A stop run. If it happens on low volume, it's a fake. The whale is checking the fence before releasing the bull. Stay calm. The hardest part of investing isn't buying, it's holding. When silver hits $70, your instincts will scream to sell. But ask yourself, sell into what? Overvalued stocks? Negative yield bonds? Inflating fiat? The whale isn't selling. It's consuming. You're not trading silver. You're banking in it. You only sell to acquire something real: land, business, independence. This isn't a weeks-long move. It's a multi-year realignment. We began with a flat chart at $63. We uncovered a hidden buyer. We connected it to AI, energy, and supply physics. This story isn't about the federal. It's not about inflation. It's about math. We are trying to build a hyper-electrified future using a supply chain we stopped investing in decades ago. When the math breaks, price solves the problem. Scarcity is coming. By holding silver now, you position yourself ahead of the most powerful entities on Earth. The whale is finishing its meal. The iceberg is melting. The vacuum is opening. Hold the line.